All right, welcome back. Well, the IPO market seems to be picking up the pace this year a bit. Apparel maker Amer Sports debuting on the NYSE today, with Reddit and Shein, two other names expected to list in the coming months. But the billion-dollar question is, are these really the IPOs that Wall Street wants? Deirdre Bosa digging into that for today's Tech Check. Dee.
So, Sally, if you're like me and you love IPOs, all new listings, then sure, we're going to get some exciting names this year, but these are not like the life-changing, disruptive companies that Wall Street is so anxious for. Look at this graphic. On one side, we have the IPOs that Wall Street wants. These are those big disruptive names, $40, $50 billion plus valuations like ByteDance, SpaceX, Stripe, Databricks. They're household names or they're Silicon Valley darlings that investors you would think might be clamoring over themselves to get a piece of. On the right side of your screen, you see the IPOs that Wall Street is getting. These are the candidates for this year, the likely candidates, I should say. You've got Discord, Reddit, Skims, Plaid, Chime. I'm going to put Shein in a different category in a moment, but these are likely, around $10 billion valuations, solid business model, perhaps. We'll have to judge once you get those S1s, but, they're not the big and exciting names. And part of that is there's this disconnect because the bigger, flashier, buzzier private companies, they can continue to tap private markets for funding. So that pushes out an IPO. They can wait. And there's also a little bit of stigma, especially here in Silicon Valley, about going public and being a slave to the quarterly report. Whereas the other companies that aren't quite so buzzy, that might not generate as much interest, and by the way, may not perform quite as well, they can't tap private markets as easily, so they need to turn to IPOs. Brian, I said that Shein is in a bit of a different category because this one, at least to me, is very, very exciting. It is sort of a disruptor. It's been making huge waves over here in the U.S., even though it's a Chinese company or Singaporean, as it wants to be seen. That's up for debate. But that one right now even looks to be in a little bit of peril. You had a report that existing investors were looking to sell shares in the private market because already there's being some cold water being thrown on that one.
Yeah, and by the way, Shein eats my timeline on X with other ads, probably in other platforms as well, Dee. But here's the thing. You're out there in Silicon Valley, home of venture capital, right, and private equity and all this stuff. You just feel like more and more money is just being made. We talked about it on my show last night. More and more money is being made in the private markets. In other words, the real money, the big money. They get in on the companies before they go public, and that's where you get the 30,000 square foot house in Atherton.
I mean, that's always been the case, right? Venture capital works on this idea that you're going to invest in 100 companies, and one of them may turn out to be your lottery ticket, right? You might have invested in the Uber or the Airbnb. They need exits, right? And that's venture capital. Private markets typically lag the public markets. They do need exits. They need more of their companies to go public. Doesn't even have to do that well because they got into them at such early stages. But there's another dynamic at play, which is new over the last 18 months or so, and that is mega cap tech money. Billions and billions of dollars, more than the venture capital world has really ever seen, save maybe SoftBank or Tiger Global, investing billions and billions of dollars into these new generative AI darlings like OpenAI. And Anthropic, but also some of the smaller ones, right? They're fetching billion-dollar valuations easily. They're unlikely to go public as well because money's flush for them.